All right, we're back with the commodity report. Sorry we couldn't be with you guys on Monday, but we're here with you guys on Wednesday. So we'll be here every week, every time we can possibly be. We'll put this together. I'm glad you guys reaching out to us and saying, we really missed the show. Like that keeps us motivated, keeps us putting out good content. So I appreciate you guys reaching out. But just looking over the basics, over the last month and today, we'll talk about some one-day performance because we have some outliers today that's quite interesting. Kevin last week was talking about Palladium, the short squeeze, the bounce that could possibly happen. We absolutely got that bounce. 12% in a week. What's it at now? I mean, it's up 3% today. Is it near 15% in the last week or so?
Yeah, around that. Yeah, because that 12% was calculated yesterday?
Yeah, so I mean, so let's look. Yeah, almost 15% up, 14% in the last week. It's a big move. Silver's up 4% today. Copper getting touching right above my stop over and over again and making me want to just cry some days because that's what copper does. So commodities do in general. Copper has bounced today up 3%. Let's see if it can hold that. I don't know. That's the thing about the way I trade, I don't know anything. I don't try to say I know what's going to happen in the future or what I'm really thinking. It's more of the signals are long. We stay long the signals. I try to think that my models and my systems are smarter than I am. And I think that's true most of the time. Most of the time, they prove me very, very wrong. So we'll see where that can hold up. I wanted it to see it get back above that $4.50 level. It is holding above that level. We'll see where that ends up. Platinum also was one that started to make a bit of a move lately. This was one that's been kind of dead money for a while, just chopping sideways for a long time. Had a breakout last month, basically gave us a false breakout signal. Broke out, came right back, stopped me out. And now it's kind of trying to give another buy signal soon. We're not there just yet. Above 1050, we'd be more interested in it right now. It's just kind of chopping around, so we'll see where platinum ends up. And then performance over the last month, the leaders are Palladium in first place. Great call from Kevin. Heating oil in second place. Quite interesting to see heating oil being the one that caught up. That's pretty cool. And once again, Kevin mentioned earlier, what we'd want to see to get bullish on the energy in the oil space in general is kind of seeing the heating oil and then gasoline start to really catch up and start to catch a bid. So now we're finally seeing them catch a bid. Oil's right behind that, up almost 12% in the last month. Sugar has been one that's really been trying to run the last couple of weeks. That's going to be something we can ask Kevin about in a little bit as well. And then behind that, we have the feeder cattle and live cattle just kind of chopping around, but those are still up. Those have had a good run lately. Are we hitting new highs in feeders yet? No, yeah, we're getting there. Look, it's getting a little bit closer. We're also seeing that commercials are starting to step in again on feeders pretty heavily. We'll talk to Kevin about that as well. So, Kevin, what are you seeing out there this week? What's interesting to you?
Everything. And I do, just to kind of call out too. I do apologize. We've had to kind of move these things around, and we'll try to do them as much as we possibly can. And then two, just kind of note, when I have these, when I talk about certain markets, I'm not making any recommendations. We're just talking about the landscape of the market itself, right? So the Palladium type of situation was completely oversold market. And we had tailwinds basically when it came to the EV numbers that were coming out. That's really the play that was there. When you have these EVs or even the hybrids and things of that nature, there could be a little bit of a draw when it comes to some of these metals as a whole. And when you got the China data that came out, not only just for EVs, because EVs and Palladium, not so much of a tie, but when you're looking at hybrids, that's where you kind of see that demand. So once again, we saw that spike to the upside here. One thing to note about Palladium, still it's a very tough road to the upside. So when we kind of highlight some of the technical and fundamental factors, just understand that those can be short-lived. And so when you see these type of pops, you look at them, you notice them, and then you kind of move on to kind of the next thing here. But yeah, nice little pop when it comes to Palladium. Heating oil too, nice little pop, kind of subsiding here in today's session for the most part. It kind of seen some mixed action, but once again, heating oil inventories were the first ones to build. We saw the refining mix focusing more on gasoline, and then once again, kind of if we do see this rebound or this summer driving type of season, the transportation sector trying to rebound here because it has been in a lull. I call transportation when you're looking at intermodal is for the most part in a pseudo recession in some respects there. So keep your eye out on that. But nice little pop, nice little run. I think it was up around 15%, give or take from the lows. Decent. We had the EIA numbers that came out today. Let's actually hit on that first. So the EIA numbers that we had today, significant draw when you're looking at crude oil inventories. That came in a draw of 12.15 million barrels. Street was looking for a draw of 400,000 barrels. We had the API report yesterday that showed a draw of around 9 million barrels. So there was a substantial drawdown that is there. Now, knowing that, if you look at it, wow, that's surprising. And it is. In some respects, distillate stocks dropped as well. Gasoline inventories, bigger draw than the street's expectations. All that's good and well. We had the same type of scenario that happened at literally this time last year, though, Jason. And this is the time where we actually did see oil kick to the upside. The dynamic is different when it comes to consumption, though, because the consumer is still a little bit weaker, trying to ramp up here. We are starting to get closer and closer to those 2023 levels. And if we overtake those 2023 levels, knowing the backdrop that we're at right now, that can be supportive for prices when you're looking at oil in general, and when you're looking at a lot of these energy products. The key for this report, and the reason why you didn't see a sustained pop to the upside, is that product supplied, for the most part, wasn't anything that was shocking. If you had that big draw, you would think, okay, maybe they're pushing all of this stuff to the refiners, and there's just going to be this huge glut of inventory in the next couple of weeks, which that could be the case. But the real bright spot for this report was the jump in exports. Exports increased by around 10%. If you're looking at the barrel per day increases, around 491,000 barrels per day increase than what we saw for last week. That is what we actually see as the major bright spot here. Once again, seasonal trends. Is this going to continue? Potentially. There's weather premium in the crude oil that's being priced in right now because of the Hurricane Beryl that's taking place. That should not actually impact any major oil infrastructure, any rigs or any ports. What could have an impact is the transportation of oil and gasoline products between the United States and Mexico. So kind of be mindful of that. And that actually might actually distort the EIA data that we have. Maybe not next week, but the week after that, because it's supposed to hit the Gulf next week. So just keep that in mind. That's where we can have this distinction. The U.S. exports gasoline and finished products to Mexico. Mexico sends us the oil. So that's going to be the transit there. So that's kind of what I'm looking at. Nice little bounce. We have the chart up here, 3-year weekly chart. I like the weeklies. 200-week moving average. Once again, key area. We talked about it bouncing off of that level. It did. We talked about that descending channel line that has been broken. That has occurred. Now we are looking at a resistance level of the primary ascending channel, the expanding megaphone, if you will. And if we do see a little bit of a technical pullback, it would be around 72.5 to 73.5. Depending on how thick that line is. And then maybe we see a little bit of a pullback, come back, retest, and try to push higher. But once again, as I talked about on that chart, that mini blip in the middle of that chart going to the upside, going from $70 to $95, was the same week that kicked off the same week as we saw this inventory draw with the EIA. Completely different landscape, but something to be mindful of. Can we see a summer rally in oil? It is possible here, but you need to have the gasoline demand really being reflected. And then that needs to be reflected right now as we have obviously the holiday and then the summer season, really officially kicking off.
Yeah, and I also like that you brought up the seasonality. I thought this is interesting. If you go back 41 years, it's basically as much data as they have on oil on TrendSpider or most of the seasonality accounts only go back 40, 50 years. But going back 40 years, you look at July as the best month for oil. Something to keep in mind here. It's not that seasonals, we can't just look at them and go, okay, I'm going to trade off seasonals completely. We want to look at it, pay attention to it. Are the technicals also making sense? And as we're seeing there, we get that bounce off of that very significant moving average that Kevin keeps talking about, which is the 200-week moving average. These are significant. This is why I always talk about primary trends. things like 52-week highs, things like 200-week moving averages. These are the primary trends. This tells us where we should be positioned, what we should be looking for to enter, what could bounce. And it's also like for a lot of people, if you're looking at it in the 200-week moving average, that is like technically, if you look at it from a technical perspective, that is the major value area. It's a major area of value. A lot of people look at it. Yes, I understand there's going to be people who you think don't look at that moving average, but I promise you, nearly everybody, I don't care how fundamental they are, they have a 200-week moving average on their chart somewhere.
Yeah, I think the actual moving average itself. I like the 200-week because I think everybody else uses the 200-week. But the actual moving average is the 210-week moving average. That's really that gauge there that gets you to around that 4-year time frame, which everybody kind of looks at.
Yes,
200-week works really good.
Yeah, I mean it's more of a you see a lot of buying comes into those areas, and there was a guy I used to trade with who called it Algo City. And like basically just, and I actually don't think the guy understood algos or anything, but I just think he used the term because he thought that's where a lot of buyers usually come in. Systems start to trigger at that point, and it's not wrong, So if you look at it and you just think, okay, this is where people start to buy. This is because really, like, there's few people that are buying. Like, some professionals are buying breakouts. Yeah. Not the average investor. So the average investor, even the big time investor who's basically sitting there looking for things to come into value areas, they're also looking at these zones. It's not because only the 200-week moving average, and Kevin probably could attest to this as well. It's that it's usually around major support zones, major zones of interest where producers would be interested in it price wise and so on. So a lot of things kind of link up with those zones a lot of the time. So what are you thinking about the distillates right now, Kevin? What do you think about heating oil, and so on?
Yeah, so I think oil is gonna do its thing here, right? So when we're looking at these products, you got to see what's gonna push what price, what's gonna push what, right? Because they're all interlinked in one way, shape, or form. And you would think in an efficient market that producers and refiners are going to adjust based on market dynamics, and so. The distillates, or if you're looking at heating oil, if you're talking about diesel, I'll start calling it diesel so I don't confuse people. But if you talk about diesel, you have a situation where we know demand has waned, and demand has waned for a very long time. We know that inventory levels have been building up. We're starting to see some draws on a week by week basis. And you look at that and you kind of say, okay, technically, potentially oversold. Commitment of traders report, potentially a significant amount of short positions that are in there. And then what we call it that catalyst, or that spark. What's that spark that can actually drive this higher? And I think the spark that could drive it higher here is potentially is going to be the fact that if we do see gasoline demand starting to rise here a little bit, we could then see, once again, further neglecting of trying to refine for diesel. And then that's kind of where we have this overall shift. And then you have the seasonality side of it too, where diesel prices, for the most part, start to see a little bit of a spike in activity or an advance in price traditionally on a seasonal basis, starting in around October, because you still utilize actual heating oil in New England, where they're utilizing heating oil to heat boilers. And so you have that demand that's going to be there, as well as some of the trucking demand that's going to be out there, which is a little bit more robust, if you will, in the winter months, and could actually spark demand. So that's kind of what you're looking at there. Gasoline, I think it's a lofty prediction or a lofty thought that the consumer is going to have this complete turnaround in the summer months. I still think that the consumer is going to be weak. You're kind of seeing that with a lot of the data points that we've seen over the last couple of weeks, right? Like the consumer is feeling some pressure. But when it comes to travel, if the consumer is actually utilizing driving rather than flying, because the cost of air travel is still relatively high, then that could kind of be your backfill. So it's not the overall fact that everybody's traveling. It's just those that were maybe traveling by air may actually travel by car, just because of the overall landscape, and you can kind of stretch out. You can kind of stretch out certain vacations, right? Instead of maybe going to a place and you stay there for 4 days over at Disneyland. And enjoying Disney for 4 days, which is very expensive. Maybe you take a drive to Disneyland and you go to Disneyland for 2 days. That's the kind of the thinking that I believe probably will occur. So even though you kind of have a different mix as far as travel, you're still going to have that demand side that's going to be there. Jet fuel, I bring that up. Jet fuel inventories have increased at a very rapid pace. We are seeing some elevated levels there, which is not surprising. The thought processes from industry experts is that the buildup in inventory is in preparation for this season right now, going into the remainder of this year. So having a very strong and robust holiday season, not only in the summer, but also when you're looking at Thanksgiving, which is the biggest travel season is in Thanksgiving, and then also pairing that off into December for Christmas and some of the other holidays that are out there. If that's going to be the case, then once again, there can be a demand story there. If that does fail, though, then that's probably where you see a pretty significant reversal when it comes to prices. I think that's, once again, so it's a novel idea. We'll see if that actually comes to fruition. And if it does happen, then you would correlate that with airline stocks, which they're very hard to trade. I don't want to get down that road, but then you would look at airline stocks and maybe say, okay, maybe the travel demand is actually picking up. If that's going to be, if the air travel thesis that some experts have does hold. But that's why I've been looking at jet fuel inventories. The reasoning for that is the expectation that travel demand for air is going to be strong in the latter half of this year. Once again, I already kind of talked about, I think travel is going to be mainly by car rather than by air. We'll see.
No, I'm for the first time in a long time. I just pulled up the Jets ETF. I haven't seen this thing. It hasn't been on my list. I haven't got a signal for it in God knows how long. Maybe 2020 would have been the last one. But once again, it's the chart looks terrible. So it's something to kind of pay attention to. If you see that turn around, I mean, it's had 4 down weeks recently. Most of the time you see a bounce after that. Let's see if it turns around, maybe make some move to the upside, taking out those old levels, like even around $20. If it could get above 20, it's sustainable up there. That would be good. Let's get the actual price for like a 100-day high would be 2260. So it's got a lot of work to do. But once again, you'll see it. It's something that Kevin and I think we do very well, is kind of giving you the things to pay attention to. Put it on your list. Watch through the charts. See what's going on there, because the price action is going to show up before the data. So if you're constantly looking at the price action and then you go, okay, well, the data is now coming out. The data is also making sense. Then we can kind of say, hey, the idea, the thesis is actually true. Because really, I think, Kevin, you're onto a good thought there, because it is true. Like, instead of taking like a 10-day trip, hotels could be, $500. Like, I just looked at a hotel we stayed at a couple of years ago, and it went up by like 100%. It was $500 a night. I paid $250 a night just a year ago. And so, like, just thinking about it like that is like, and we were there on 4th of July, which is also crazy. So it went up that much on the holiday, and outside of the holiday as well. So it's wild. But if you're looking at things like that and you go, well, I really like that place. That was a great place to stay. Well, instead of going for 10 days, we'll go for 5 days. We'll go for 3 days, like whatever it is, because you still want to go on a trip. You still want to travel. A lot of people have like annual vacations they do. So I do think that makes a lot of sense. And not to mention, there's also another aspect of it where people are kind of doing more minimal things. People are going camping. People are going to cabins. People are doing something a little bit different than just going to a crazy resort or an expensive hotel, because it just doesn't make sense anymore. So I think you're definitely onto something there.
And just to clarify too, the thesis is, if you saw jet fuel inventory starting to draw and we see those travel levels, that should improve airline fundamentals. I'm not making a call on airline stocks or anything.
No, I'm more saying,
but that could be like it could be a leading indicator for that sector that has seen, actually, like, we saw a decent little bid for airline stocks because every single quarter it seems like they come out and they say, hey, our guidance is looking great, travel demand's not a problem. And then 3 weeks later, they come out and say, oh, well, like it's deteriorating and it's going to be lower than our expected. And it's like, what happened in 3 weeks that has really changed your mind? And I'm not joking. That's literally happened like way too many times over the last 2 years. So that's kind of what I'm kind of referring to.
No, I agree, and that's more of what I'm also saying too is that one, I'm probably not going to get a signal in airline stocks probably this year. I'd be surprised, but it could happen. Anything can happen. But what I'm more saying is when we're talking about a thesis and idea, pay attention to the sectors, not because we're planning on buying the Jets ETF, planning to make sure what we're thinking and our ideas and what could happen with inventories link up. So just as Kevin said, to echo, not looking at buying the Jets ETF, just talking about what could possibly happen and double checking our work. That's for any trader. Any trader has to just, because that's the thing. And I always love that quote from Reminiscences of a Stock Operator. Like you basically pay the market a premium to prove you're right, your thesis is right. So for example, if you're looking at the Jets ETF and you're saying these things and you actually, let's say you're a person who loves airline stocks, you'd want to watch it break, take out a moving average, get above a certain level, something like that before you would just go in and buy it. And that's kind of the premium you have to pay to the market to know you're right instead of just thinking you're right. So let's get into natural gas. I wanted to ask you about this today. I was thinking about natural gas lately, the summer months, what's going on. You called it perfectly, actually, coming back to that $2.50 level. So I wanted to ask you about that. Another good call from Kevin. That was weeks ago, actually. So, oil or natural gas was up near the $3 level, and Kevin said he thought it could come all the way back to $2.50 pretty easily. It's at $2.46 today. So, Kevin, what are you thinking about natural gas? Do you think it's going lower, going to go all the way to that $2 level? Do you think it's going to go back to $3, range bound?
Ooh. Yeah, that is a good question. I think we're kind of in no man's land when it comes to natural gas right now, right? Like the $3 level is a key technical resistance area where it kind of is very difficult when you're looking at the industry data to really see that follow through right now. Now, when we kind of talk about that, the reason why we saw that build up to the upside, a couple of reasons, right? Short covering, that's the easiest one to be able to call out for natural gas, pretty much for any pop. And that's something you can look at the Commitment of Traders report. There also the extension or the increasing of heating days. I call them heating days. The EIA calls them cooling days, the reduction of cooling days. So basically meaning that the projection is that we're going to have a longer or hotter or a longer summer, basically, right? Longer summers would mean that air conditioning demand, cooling demand itself is going to increase, and that could also lead to increased demand for natural gas and yada, yada, yada. Okay. Energy, all that stuff. But obviously that's faded here a little bit. It's still a tough market for Natty. I would say that from a technical standpoint, the 20-week moving average sitting at $2.16 could be your near-term area of support that you could try to test. But when you're looking at a lot of these indicators, right, stochastics on the weekly already crossed, bear cross. That was actually when we talked about that. So that was, if you guys want to go back, 2 weeks ago, we started seeing the hinge to the downside there. CCI doing the same thing, RSI doing the same thing. MACD looks like it wants to cross and it hasn't. And once the MACD crosses, that's kind of where you get those major flushes to the downside. I'm not sure if it's going to get down to those lows of $1.52 from a technical standpoint, but I do believe that we probably will see maybe a little bit of a bounce at $2.17. The interesting development that I got to still get more information on is Ukraine is striking a deal with Azerbaijan to be able to supply Europe with natural gas flows, because there has been a little bit of concern there. And we do know that LNG exports or LNG shipments are kind of diverting over to Asia, slowing down a little bit in certain pockets. But that's been the reason why we kind of have seen this a little bit of a slowing and refilling inventories in Europe, even though inventories are still at a pretty healthy level. They want to max out those inventories as much as they possibly can. because once again, that could be an issue. So, yeah, I would say natural gas, that's kind of where I'm at right now. When it no man's land, 216 immediate area support. If not, looking at potentially $1.75 might be a little bit tough there. And then there's the seasonality for natural gas going in the latter half of this year, similar to heating oil. So then those two will start kind of trading more in a stronger correlation than what they do right now. That period between, I say September, but it truly actually starts in October and then goes through the January period is usually kind of when we see those stronger correlations. Not gonna be one for one, but stronger. What do you think about Natty though?
No, I agree, and that's the same thing. It's natural gas is always tough. It gets long in the tooth. You have this oversupply issue all the time, basically. It's always tough to create major trends on it built on fundamentals, but you have these major pops that happen, these major trades that can happen. It still actually has been a great trade this year. However, it's come back, it's taken out old lows. It possibly, like you're thinking, it possibly has some more downside. But if we're looking at natural gas, if you look at seasonality and go, okay, July is actually a terrible month for natural gas most of the time. If let's go back a little bit further, I'm only back 10 years. So let's go back to the 90s. No, still looks exactly the same. Let's go back as far as we can. 91 still looks the same. So basically, natural gas in July is a terrible month for it. Only up 41% of the time. But August, if you only go back, 20 years, you look at August and it's up 70% of the time. If you go back to only in the last 10 years, let's see here, go back 10 years, it's up 90% of the time. So natural gas has and that's because of air conditioning, because of more energy usage and so on in the summer months. And people would think that that's going to just happen in July, but usually things show up a little bit later. So look at August for a possible turnaround, but I also agree with Kevin where I think natural gas is kind of in no man's land. That range is going to be wide, though. That's something to pay attention to. That range is going to be wide. So if you're a range trader, you're going to make some money right now. If you're a trend trader like myself, you're going to get frustrated right now. And that's just going to happen. But looking at towards the end of the month for possibly another move higher would be smart. So the possibility of a breakout, look for it to close above that $3 level. Then possibly could head upside again to maybe, I'm not looking at the chart right now. So let me actually bring up a chart of Natty so I can speak about it properly. So if I'm looking at natural gas, getting back to those levels about 365, those old highs from 2023, 365, getting back up there to 368, that would be a pretty good move in natural gas. So, but you want to really wait till you see it close over $3. I know it's going to be hard to do it because you're going to see this huge range. You're going to want to jump in day after day, or you're going to see the bottom of the range and go, I can buy it here. I would just wait for that breakout zone. And then you could possibly take it up to that $3.65, $3.68 level.
Yeah, and that's once again, kind of if you're looking at the chart, when do we see those ramps? September, October. Mm-hmm. So that's also going to be the reasoning behind that. And then if you're, let me not go down that route. If you're kind of looking at the structure. I'll go down that route. I don't care. Let's go. All right. So if you're looking at like utilizing UNG as a proxy for this, understand that UNG, the ETF, kind of like USO, right? They have futures contract exposure, but their futures contract exposure is spread across multiple different expirations. So you're not going to have a 1-for-1 beta. So if you're looking at that seasonal type of level, just understand the fact that the UNG is going to have burn off roll costs until it gets to that seasonality. So as an example, if somebody were to do something, it would be like getting longer, the longer dated options, right? And then trying to sell calls against that until those contracts, till that front month contract can be the leading contract for the ETF. And then that's where you kind of see those moves. So just kind of know that you will see a disconnect when it comes to pricing if we look at a curve of natural gas, because the natural price action for natural gas is for higher prices for the winter month, late fall, winter month contracts rather than summer month contracts. So I wanted to kind of highlight that out because you're going to have this dispersion in the underlying with USO right now, where your front month contracts, the summer contracts are going to weigh down on that price action. And you don't have as much of a levered position to the active fall contracts that traditionally do see the price advances. That's really what I wanted to highlight there.
Nice. No, I like that. And it's important to also understand those things and talk about those things, because it's like you have to understand how they're structured, and the reason why people like us trade futures. That's one of the reasons why I trade futures. I'd rather have the actual underlying product, have control over it, and so on. I mean, nowadays there's so many different micro products that most people can trade futures. So you don't have to always trade those ETFs. But so Kevin, before you go, I want to talk about the grains. I think that's something that everybody's probably curious about. What's going on with cotton? You sent me this chart. What are you thinking here? What's going on with cotton? And then we'll go through wheat and corn and soybeans.
All right, so bold call here. North Carolina's crops are pretty much not great. Really bold call. If you look at the crop conditions, unfortunately for last week, it was at 32% for good to excellent. That actually beats the low that we have seen since this has been tracked at 33% back in 1997. So next week, last week's low will then be the new low or historical low. Once again, worst conditions for excellent to good quality since 1997. Now, kind of a big deal, but also understand we also have, for the most part, a little bit of a glut when it comes to cotton across the board. Demand has waned. There's a lot of foreign competition that is out there as well. But I've read several different articles, several different analysts that expects, I'm not making this call, but expects that potentially 99% of their crops will fail this year, and that it's not fully reflected in the actual data yet. For the USDA, but they do believe in the next couple of weeks that it will reflect that. And that's an unfortunate situation. This is how weather patterns can actually happen, right? You can have good weather, you can have really bad weather. And if you have bad weather for too long and you have extremes for too long, this is what can occur. Now, once again, they're not the only producer, right? There's multiple producers out there when it comes to cotton. We have the inventories, the ending stock inventories are decent. I think the USDA is trying to price in, for the most part, as much as they possibly can, that they will see significant crop failures when it comes to North Carolina. But once again, experts within that region do believe that I'm not going to say 99%, over 90% potential crop failures this year when it comes to the cotton crop. And they do believe that that's going to also translate into the corn market as well. So it's an unfortunate situation. This is why we watch and maintain and look at crop conditions, and you want to see where this is kind of heading. And you can also kind of see on that chart too that it's not just North Carolina that's feeling the pressure. You can see other places in the market that's kind of feeling a little bit of pressure here. Texas feeling some pressure. I don't have the corn one up for you guys, but Illinois feeling the pressure. They're having some problems right now, too humid. Disease risk that's out there. And so these are the type of things that can happen in these agricultural markets. When you're looking at price action right now, it doesn't look too great. So corn hitting a key area of support at 419 cents. So $4.19 a bushel. That looks like, and unfortunately the technicals are kind of signaling that it wants to continue to break. Let's see if some buyers actually step in when it comes to the corn market. When you're looking at wheat, trying to catch a little bit of a bid. Saw some buying activity at around the 560 area there, testing the 20-week moving average. Once again, a little bit dire when you look at the technicals, though. MACD just crossed, stochastics crossing. Not a lot of great things that are on the horizon there when it comes to wheat. And soybeans, poor soybeans has broken to 3-year lows at least, and I am going to check back on this chart to see. The soybeans are trading at the lowest levels that we've seen since, November 2020. So, and if you kind of look back at the chart, you actually could go even lower than that. I mean, if you were looking at April of 2020, wheat was trading at 808. Or so, I'm sorry, I said wheat. Soybeans is trading at around 808. So the downtrend has stayed intact. We did reject off of that 20-week moving average. That has been an issue for soybeans over the last, let's say, 2 years. 2 years, and it seems like that trend is going to continue. So no bright spots there. Sugar, you talked about that. I think there's in Brazil, there's a little bit more of an export demand that's taking place there. So you gotta have to kind of keep that in mind. I think it's more ethanol production that's taking place. And then I had one more thing. Oh, the oils though, soybean oil is catching a bid. So with soybean oil, what's actually happening there is there's a strike that's taking place right now in Argentina. And so that is also impacting their crush operations. And so when that does occur, demand for soybean oil here in the United States does actually kind of go up from an export standpoint. And so that's why we've been kind of seeing a little bit of a bid there for soybean oil. I don't know how long that's going to last. The analysts out there believe that these strikes are only going to last for this week, and then by next week they're going to have a resolution. But we have seen a little bit of a bid when it comes to soybean oil over the last couple of trading sessions, and that's the reason why.
And we got a signal on soybean oil just yesterday that we put out in our group. So we do see that as a potential opportunity. However, once again, we're kind of in this death spiral almost in the ag space. I really do like wheat coming into next month. I really do like corn even coming into next month. I think some of the data that you're talking about here is going to start to really show up at that point. I think we're starting to see the beginning of it now. We're starting to see that people are having trouble. Like if you have any info or connections with any farmers, you'll talk to them and they're having a miserable time wherever they're at in the United States right now. It reminds me very much, and I like this one thing that you had on this chart, Kevin. The one thing to talk about, the select states low year, 2011. You see a lot of 2011s on these things whenever you kind of go through the crop conditions. And the reason why is 2011 was a terrible year across the board. But at the same time, if you go back and you look at the charts look very similar to 2011. You see these major end run periods where, the commodities are falling like crazy during the summer. And then next thing you know, all the sellers are kind of wiped out. All the buyers are kind of wiped out. Everybody hates it. And then next thing you know, it starts to catch a bid. You start to see short squeezes. You start to see breakouts, and you start to see trends. So I am very interested in seeing how this goes. July, we don't have a signal for wheat, corn, or soybeans anymore at the moment. So there's no longs in any of these, but I would be open to taking signals as they come in. So I think the good play here is to continue to wait for these things to break major levels. Those levels being, cotton being one of them, one of the levels being getting above that 76.14 zone, really getting a good close above that zone would be something that I'd want to see. $76, a close over 76, I'd say, hey, take a swing at cotton. Same thing with if we go to the grains, go to wheat. You see that major downtrend. Now, soybean oil, we already talked about that. That's already in a buy signal. We take a look at wheat. Wheat's trying here. It did make a higher low. I do like when I see a higher low, but I really want to see it get above that 646 level. If it could get above that 646 level and hold there, I would absolutely say, hey, take another swing at it. This thing could really have a trend. Short-term traders, though, looking for something that's a bounce off of these levels, I don't think that's a really crazy trade either. You could get a pullback here. Let's say we get back to that 560 or even 570 level, buying it, looking for a short-term trade back to that 640 level. I don't think that's a hard trade either. So I think there's a lot of opportunities here. But once again, I think that it's important to continue to sit on your hands during times that look like this. That's always got to be important and high on your list. Sitting on your hands, thing to do.
Yeah, for sure. I would call out to that soybean oil. I saw it spike. I didn't see it spike this much. So it is up over 8% this week alone.
Yeah.
Once this issue abates, though, just
could
understand the market will most likely will correct itself. But
Mhm.
if you see that divergence between soybean oil and meal and just soybeans in general, that's really what we are. That's the main reasoning for that one. This is what I'll leave you on this one, man. Like me. Always
Mhm.
just
Gotta leave on a big note, man. Big note.
lean hogs.
All right.
Not looking good. Not looking good at all. Unfortunately, weights have gone up, demand has gone down, slaughter has, for the most part, kind of dropped here. And there's a thought that maybe we do have too much oversupply. Now, man, I don't know when we're gonna get this report, but you want to get this. There's a report like that's called like the like a frozen report, right? And it basically looks at meat stockpiles that are in refrigerators and freezers. And so let's see where those levels are. I don't know when that actually does come out. I've fallen off of that particular report over the last last month or so, but the production weights. Let me bring up this chart here real quick. I know I'm going to try to be quick. Anytime I need you. Okay, cool. Weekly hog slaughter has started to turn down. Now it's a seasonal downturn or trend that we do see between July and then let's say mid-August. So that's something to keep in mind there. Production rates look like it's going to hit a seasonal trend as well. But once again, when you're looking at the weights of these the hogs, I keep saying cattle, hogs. You see the weight of the hogs. That's something that has been a little bit of a concern for a lot of traders out there. Chart doesn't look great. Sometimes you look at it and say, hey, has it gone too far, too fast? Maybe. But when you're trading livestock, that's not how you should be thinking at all. You usually follow those trends and you listen and keep your ear to the ground. What's going on in the auctions, what's going on at the slaughterhouses. And until they tell you something different, you don't fade that trend. The export report when it comes to China and their purchases could turn this around if we do see a spike when it comes to exports. We haven't seen that, though, unfortunately, right? A lot of this has been domestically driven. And so I will leave you on that. I think we should probably follow up with that one next week because the chart's god awful. And it has actually been something that has sustained itself when you're looking at price action, at least for the first half of this year. Nice little power move to the upside, but it has faded since the contract change.
Yeah, and it's retraced almost half of the move already. So, I mean, that's something to continue to pay attention to. We'll talk about it more next week. We'll cover more sugar, cocoa, and so on. So, guys, thanks for joining us. We'll be with you next week on Monday, and we'll see y'all soon.